Good afternoon, guys. Happy Friday. Happy Friday. Welcome to our new segment, which is called Food for Thought Fridays. So my marketing team looked at the video I posted last week with tips of the day. We actually need a segment for this Friday thing, right? So we decided if we go live or we share a post, the segment will be called Food for Thought Friday. How catchy, right? These guys are on the ball, if you ask me. So tip of the day today on our Food for Thought Friday is the two major ways one can actually buy life insurance, guys. So I'm sure right now you're like, yeah, well, there's only one way one can buy life insurance, and that's through money. Unfortunately, you're wrong. There are two ways you can buy life insurance. Money is just the tool or the premium that you pay, but you'll understand in a bit as to why these are the two major ways you can actually buy life insurance. So these two major ways are your age and your health. Yeah? These ways are the only two ways you can actually buy life insurance. Now bear with me while I break it down for you. Also, guys, for the longer videos, please do make use of our YouTube channel. It is live and fully active, so you can gladly go catch the full videos on there. We will be sharing the snippets on the TikTok platform, but yeah, we will no longer be using TikTok for the fully length videos. We've noted that we all have shorter attention spans on certain platforms, so if you want the longer video, please gladly do jump onto YouTube and watch the full video on there. So with regards to the age and health, guys, these are detrimental to you basically purchasing life insurance, right? So I'm going to start maybe with the investment aspect because that's a bit too direct, straightforward. In order for you to maximize on your investments, you initially or essentially have to start while you're still young, because you've got time working on your side. And that's a major factor. For instance, just to give you guys an example, I've been doing projections in the past month or so, and clients' differences with regards to age differences is a major factor when it comes to their retirement investments. For instance, a client who is 25 years of age today and wants to get a 2 million rand lump sum at retirement at the age of 65, they would basically have to contribute 1,000 rand to their retirement annuity, right? This is somebody at the age of 25. Then a person at the age of 40, 42, 41, they would have to contribute anything between 3 to 4,000 rand towards their retirement annuity. And these are monthly premiums, guys. So I'm just making this example so that you guys can see the differences in age and the time frame of investment. For instance, the 25-year-old still has 40 years odd to go, right? The 40-year-old has got 19 odd years to go. And then somebody who's sitting at the age of 55 and is looking to retire at the age of 65, that person has got 10 years to go. Their contribution on their monthly premium towards their retirement annuity is anything between 13 to 15,000 rand. So I say this so that you guys understand that initially, if you delay the time of investing, you basically would need to start contributing a higher contribution in order to generate lucrative returns. And based on your age, you also have the compound effect working in your favor, because the more money there is in that fund, the better the compound interest, right? So these are the things that you need to maximize on, or you need to be aware of in order to maximize on them. Because for instance, certain families, say my son gets married and his wife is with child, right? The moment he tells me that, Dad, my wife is with child, I go and take out an investment on my grandchild's life, knowing that this money would either pay out when they graduate matric, complete high school, or when they graduate for their first degree. And then we tend to get shocked, Miss Nuguti, hey, some of these families are buying their children their first cars or their first apartment after matric or after varsity, and we wonder where these monies come from. But certain people or certain individuals were knowledgeable enough to basically maximize on these benefits that are there. Because can you only imagine how much they would be by the time that child reaches the age of 18 or reaches the age of 24? There'd be quite a bit of money in there. Some of them are given this money to start their own business because maybe they don't want to go to school rather, and they can use this money to reinvest in the business, open up shop, and hey, they become entrepreneurs because at least they had the capital to fund that venture. I hope it makes sense, guys, because if you delay the process of starting your investment, you basically would be faced with increasing your contribution drastically over time because of the shorter time frame. Yeah, I hope I'm clear, but I'm not going to dwell on this. If you want investment conversation, we could gladly have that in another video. So moving on to the risk policies. Your risk policies are your life cover, disability, dread disease, right? Now, with regards to these, again, these life insurance policies will cost you cheaper than they would cost you at an older age. They will be more expensive. Somebody who's in their 20s would possibly pay a premium of around 300 to 400 Rand for like a 2 million Rand lump sum life cover payout, and then still have the disability and dread disease in there. But somebody who's at an average age of 30, 40 odd, they would basically be faced maybe with anything averaging 800 to 1,000 Rand plus, depending on the amount of the benefit payouts, also with the added benefits, right? So that is a major factor as well. Age. The younger you are, the cheaper the life insurance benefits are. The older you get, the more expensive they become because you become a higher risk over time, which is standard, right? And with regards to your health, this means that in the event of you being diagnosed with a critical illness, you might no longer be insurable. So you will approach one or the other financial provider. They will do an underwriting process and realize that due to your condition, you are too much of a risk for us to take you on. Therefore, we cannot cover you or provide you with any coverage. And that will affect you badly because maybe you wanted to leave money behind for your family. You wanted to protect yourself with regards to a disability or an illness, but you just took too long to put these policies in place. And now, unfortunately, you are uninsurable, which is sad, guys. You might have all the money in the world, but if we are too afraid to take on that risk as the insurance companies, we will not take on that risk. So you would basically have to fund whatever you'd have to fund out of your own pocket, out of your own investments, have it be funding your illness, funding your disability, or the legacy building with regards to leaving money behind for your family. Yeah. So that is a major, that one is the biggest one, guys, the health factor. Because I had a friend of mine, young guy, he was younger than me actually. I think he was maybe 27, 28. And due to an underlying condition, I think it was blood pressure or one or the other factor, we couldn't take him on as a client because of the risk that was there. He was not aware of it as well, so he was not taking any medication for it or anything of that sort. So based on that underwriting process, the underwriters realized that this person has not been taking care of their current condition. Therefore, it is a bit of a risk for us to take on right now. So maybe we can reevaluate his situation in the next 3 to 6 months. And what if something happens within those next 3 to 6 months, guys? Like, yeah, tragic. So also with regards to the risk benefits, guys, there are limits when it comes to age restriction, right? Some policies do not, you cannot get cover for a 60-year-old or above 60. You cannot get some benefits above the age of 60 or 65. So no disability, no dread disease, you can't get those across board. I don't care which financial provider you go to. You will not get those benefits because of your age. So just making you guys aware, I hope this conversation will benefit one or the other person. If it's not for you, don't be shy to share our content because it might help the next person. Yeah. So those are the two majors, guys. Age and health. The only two ways you can buy life insurance. Even if you might be a millionaire tomorrow, and want to get life insurance, but you have certain underlying medical conditions, you can't get a life cover, you can't get a disability or dread disease, irrespective of how much you might have. It doesn't matter. We can't insure you. So I am sharing this just to make you guys aware that if you are still on the fence considering I will take these things up at a later date, one, you are getting older, and two, you are increasing the chance of you most likely contracting something, because as you grow older, we are becoming weaker, our immune systems become weaker, and you might disadvantage yourself in the long run. So maybe set up a meeting with an advisor, see how much these policies would cost you. You're on the fence, but you don't essentially know how much all of these things would cost you. And what if you can't afford them? You tend to spend money on one or the other takeout or Friday night dates or whatever it may be. But we all know that we tend to spend money on things that really don't matter in the grander scheme of things. So set up an appointment, do the quotes, look at the price differences, start somewhere. Rather have something than nothing at all. And for those who have something, either set up a review so that you are certain of what you're currently contributing towards. Because if you had watched our previous video, our last tip from last week, Friday, you would have realized that certain clients have accelerated benefits on their policies, but those accelerated benefits are not in line with their current needs, right? And they will affect them badly, more so if you're not aware. As well as the accidental cover, the accidental life cover. Some people don't know that that's the cover they settled for, because maybe the financial advisor did not inform them well enough, or this information was shared but they just didn't comprehend how this may affect them badly. So just a bonus tip for the day. This is one of our financial providers that we currently work with. So based on the video I had shared with the accidental cover only, we also understand that some people get declined with regards to taking up a life cover. And this is due to their illness or a critical disease that they have, right? And unfortunately, certain financial providers have declined their request to get life cover. And the only alternative for them was to get an accidental benefit, right? So we understand that at least, as opposed to not having anything at all, rather have the accidental benefit, because at least you have something. But the news I found out today from one of the financial providers that we're currently working with was that they have an accidental benefit that will accommodate somebody who's most likely been declined before, or they cannot get a comprehensive benefit because of their condition, right? And they say they offer a similar benefit, an accidental cover, but after 3 years of having that policy, it will then convert to a fully comprehensive life cover, as opposed to accidental life cover your whole life. So if you know somebody, you are that somebody who has this accidental benefit, and unfortunately due to your condition or your health, you could not get something comprehensive, you've been declined by one or the other financial provider, please do reach out to us. Let us see if we can actually get you this accidental cover on our side, so that at least in the next 3 years, it will become a bit more comprehensive, so that even in the event of you losing your life due to an illness as opposed to an accident, you can still basically get that payout. So it's not an accidental only cover. Yeah, I hope this makes sense. I hope it resonates with you all. Please do share our content, guys. Switch on the notifications for our lives, for the video feeds that we share. As I said, we will be sharing the lengthier videos on YouTube, so don't be shy to go on there and watch some of our lengthy videos that we've already shared on there. Once again, the title there, or the name of that channel, is called Long Money Convos, so that's where our future podcast will be taking place as well. So yes, guys, please do support us. We enjoy engaging with you guys. We enjoy sharing this information with you. If you have any concerns, any questions, please do not be shy to reach out. We're here to help. Until, of course, you say, Tabang, I need a certain benefit from you. I need. Then I will charge the financial provider that will be getting you that benefit from. But from me to you guys, a lovely and a safe weekend ahead. We will catch up on Sunday because yes, our other segment is live on Sunday where we do our weekly rant. So it's your financial advisor's rant, and I rant about various things within the industry, advocating for the clients, advocating for the FSP, advocating for the financial advisor. So I really do believe that this Sunday's conversation will be a fruitful one, more so for financial advisors, and just to give the client a perspective and a look behind the curtain as to what financial advisors tend to be faced with in this industry. Yeah, so we appreciate you guys. Thank you very much. Please do keep showing us love. We really do appreciate it, and we will catch up with you guys on Sunday. A good one further, guys. Cheers.